is in the House talking about GM's impending
Don't knock the teleprompter. Don't knock the teleprompter. I got to do this intro. All right, hey, GM, apparently it stands for Government Motors. The automaking behemoth is now on the brink of becoming the largest industrial bankruptcy in U.S. history, and the company slated to rise from the ashes will be largely owned by Uncle Sam, you and me. Here to tell us what that means for all of us is the watchdog on Wall Street, Chris Markowski. How you doing, buddy?
I'm all right.
Yeah, so here we go. General Motors, Government Motors. Now, I want you to do something for us. You're good at breaking things down in layman's terms, and for those of us who are not familiar with all this econ speak, the bondholders overwhelmingly rejected the deal to swap debt for equity. What does that mean?
That means they are the lender. They're the creditors of General Motors. And General Motors says, hey, you know what? Instead of, get rid of all this debt, we don't owe you any more money, and we'll give you General Motors stock instead. And they say, wait a second, we don't want this. Our debt is, we're first in line. If the company goes into bankruptcy, we're going to get our money back. So basically, that's what they want. They don't feel that a future General Motors is going to be worth anything in the first place. Not to mention the UAW, which is going to own close to 17.5%, then with an option to buy another 2.5%, they think the same. They're going to take that entire whack of stock and they're going to stick it into their health care trust. So nobody really seems to think that this is going to be a wonderful investment going forward.
And of course, for GM stockholders, this means
you're going into bankruptcy.
You're done.
Yeah, you're done.
Okay. In terms of taxpayer money, we're talking about, I've heard as much as $50 billion. We got about 30 seconds.
It's not what we've already put in there or what we're going to put in there. It's what we are going to be putting in for years down the road. Once we've created another big government monstrosity, we know how that works. More money is going to be poured in, which means we taxpayers are going to be on the hook for a long time.
We all know the importance of keeping up a good credit rating. Imagine the importance, though, of a good credit rating for the world's most powerful nation. Here to talk about moodiness in the markets is Watchdog on Wall Street, Chris Markowski. Good morning, sir.
Good morning.
Okay, now I understand, some people have AAA for their car, but if the U.S. doesn't have a AAA credit rating, we're going to need more than roadside assistance, right?
Well, you think about how much it's going to cost for us to go ahead and borrow money to fund the various different things that we want as a society. You take a look, if you have a poor credit rating and you want to go out and buy a home, you're obviously going to be paying a higher interest rate. And yesterday, we saw the 10-year treasuries go much, much higher as far as yield was concerned, and that threw the market into a tailspin.
Yeah, I noticed that.
So, you're taking a look at this going forward. Right now, we have a AAA rated credit rating, and believe it or not, Kim Jong-il was our best buddy this week because there was a flight to quality in regards to where money is going to go when there's any type of geopolitical problem. But this is a serious problem going forward, and I don't know if you heard about this. They're actually considering now adding a 10% value-added tax. This is on everything we buy, a national sales tax on top of what we pay already.
Okay, so that wouldn't be good for sure.
I certainly wouldn't be thrilled with that.
Yeah. Okay, so Moody's admitted there are some long-term threats to the government's financial situation. What are those threats?
Well, 10 years ago, Bill Clinton's budget 10 years ago today was $1.73 trillion.
Okay.
Our deficit for this fiscal year is $1.8 trillion.
Oh, gosh.
Just put that into perspective. So, just 10 years ago, just how much we're spending and the increase in spending in just a 10-year period of time. We have to get this in check. If we don't want to get this in check and we still want to have all these services and health care and all these things, and if that's what the nation decides, the money has to come from somewhere. And basically what they're telling us is, you know what, you're going to have to raise taxes, raise revenue, or cut spending, one or the other.
All right, well, we got to keep it in mind for sure and take care of the government as we would our own finances, that's for sure.